Well, moving on then, Canfin Homes, that's the next stock on our radar. We have Mr. Suresh Srinivasan Iyer, the Managing Director and Chief Executive Officer of the company, who joins us on the show. Hi, Mr. Iyer. Good morning. Thanks so much for joining in. Well, before we get to the outlook on your NIMs, your growth trajectory that you're looking at, some part of the street is a little bit cautious. Will we see a cleanup exercise in the first quarter of this fiscal, or will it be, business as normal? Just in case you want to alert our viewers and your investors as well, that quarter one could be a cleanup exercise, and then we move on from there. Go ahead, sir.
No, I don't think there is anything like a cleanup or anything, because we have the last quarter itself, we had a good result. And the only thing that can come up, even if at all, that is on the restructured book, which also is too early to talk right now, because we just started seeing the book coming out of it. So as such, there is nothing in terms of the credit quality or in terms of this. However, business should start looking up. So that's what we are hoping this quarter.
Okay. So no shocker is likely in the first quarter. We just thought we'll clear the air with regard to that. Let's focus then on your cost of funds. What is it now? Incremental cost of borrowing, what is it? How does it compare with what we have seen in the past? And also, what does it mean in terms of NIMs?
Yeah, our cost of borrowing in the last quarter was 7.5%. And on the liability side, we have seen the entire impact of the rate hike already witnessed, except for a very, very small portion. So the cost of borrowing is not likely to go up going from there onwards. However, with rates starting to come down and some easing in the rates, like in the CP rates and the NCD borrowing rates, and also probably we can see going forward some, on the cost of borrowing, the rates coming down a little bit.
Okay. You said that growth is quite strong and you're expecting, good growth in the year to come as well. Can you quantify that for us? I mean, if you look at your AUM growth, it's been the weakest in the last 6 quarters. It's a growth of just about 5% quarter on quarter, although year on year, there's still almost a 20% growth. Is this 20% year on year growth something that you can maintain? Can you do better than that in FY24?
Yeah. See, in the last year, if you look at it, the third and the fourth quarter, there was a little bit of impact on the demand because of the rate hikes. So because of that, the sequential growth in terms of our disbursements was not as much. Plus, the fourth quarter is always a little aggressive in terms of, portfolio takeovers and VT outs and all. So because of that, on the fourth quarter, and the third and fourth quarter, we had a slight impact because of that. However, with rates stabilizing, we feel that the business will again be back. The demand is, in fact, looking up a little bit already. So we are quite hopeful that we'll be able to maintain this 18-20% in terms of the loan book growth.
Okay, so 18-20% is something that you can maintain in terms of loan book growth. Got that, Mr. Iyer. Your loan mix has been driven by the non-salaried segment for 3 quarters in a row, and this has helped yields, it's helped margins as well. I just want to understand, what will the contribution of the non-salaried segment be in the portfolio by the end of FY24, and how much will that help you in terms of incremental NIMs and yields?
See, presently we are having a salaried book of 73% of our book is salaried. And only 27% of the book is self-employed and professionals. And we are already, looking at a 70-30 and not beyond that. So we'll almost maintain the same mix in terms of the salaried and self-employed portfolio.
Okay, got that. Just trying to understand, that mix will be maintained, but will that help you in terms of better yields and better net interest margins as well?
Not really, because if you see the self-employed segment, which earlier had almost 100% margin compared to the salaried segment, that particular differential itself has started coming down. Today, the incremental loans to self-employed are almost just 0.5% above the salaried segment. So there's not much of a difference in terms of the yield in terms of the self-employed portfolio.
All right, Mr. Iyer, have you seen employee attrition moving to competition? Is there something that you comment on that? And how do you look at retaining your employee base?
See, in terms of attrition, I think it's a little, overstated, because in 21-22, we had a tad below 10% as the attrition. Whereas in 22-23, we had just about 10.3. So it's not, in terms of numbers, it's not a very large increase in the attrition or anything. Plus a figure almost close to 10% is something which is still very, very good compared to the industry and compared to this. Plus, if you look at if I further drill down onto the attrition, most of it has been in the lower levels where, at the entry levels, people come and have a look and then do not stay back, or after a year of probation things, we don't look at it. So it's not a very worrisome kind of a thing in terms of the attrition.
It's more like a Gen Z problem across industries, right? Attrition does not necessarily for your business. I understand that. But okay, just one final question from my end. Any capital raising that you will be needing to maintain this 18 to 20% AUM loan book growth, and any targeted ROE that you have in mind for the near term?
Yeah, so we presently are having a ROA of about 2.2 and ROE of about 17%. So at an ROA of 2.2, even with a dividend payout and all, and a gearing of 8, so about 17 or thereabout percentage kind of growth is very much possible from the internal accruals itself. However, if rates, growth goes beyond 20% or something like that, if the markets really pick up, we will probably look at something then, whenever the need arises. But about 17-18% thereabouts, it should be possible. Sorry?
Sorry, 17-18%. Got that. Just very quickly, what's the average ticket size of the loan currently, and do you see any increase in that since you spoke about the market picking up as well?
Yeah, so our present average ticket size in the last year was 24-25 lakhs. And there could be a slight improvement. One is because of the inflationary increase in the property costs. And second could be, if we start looking at the kind of branch expansion and everything that we're looking at, plus our focus on the metro and urban towns, there could be a slight increase in the ticket size going forward. So it could not be a very large kind of, we are not going to change the segment or anything, but there will be some increase in the ticket size, which is a natural kind of a thing.
All right, got that. Thanks a lot, Mr. Iyer, for joining in and speaking to us. That's Can Fin Homes, been one of the strongest stocks lately. In the last 3 months, the stock has gone up about 30% or so, and the management is bullish of an 18 to 20% growth. But let's do one thing.